Imagine a business that's barely getting by. It's not making enough profit to cover its debts. It's like a patient on life support, kept alive artificially. This is the stark reality of zombie companies. These are businesses that are technically alive, but economically dead. They are kept afloat by cheap credit, not by genuine profits. Zombie companies are more common than you might think. They exist in various industries, from retail to technology. Their presence distorts the market and poses significant risks to the global economy. Understanding this phenomenon is crucial for investors, policymakers, and anyone interested in the health of the global economy. The rise of zombie companies is a relatively recent phenomenon. It's closely linked to the era of ultra-low interest rates that followed the 2008 financial crisis. Central banks around the world slashed interest rates to stimulate their economies. This made borrowing incredibly cheap, even for struggling businesses. Companies that would have otherwise gone bankrupt were able to stay afloat by refinancing their debts at lower rates. This created a moral hazard, where businesses were incentivized to take on more risk, knowing that they had a safety net. As a result, many companies became hooked on cheap credit, like addicts dependent on a fix. This situation was further exacerbated by the COVID-19 pandemic. Governments and central banks injected trillions of dollars into the global economy to prevent a complete collapse. While these measures were necessary, they also created a breeding ground for more zombie companies. The easy money kept many businesses alive, even if their long-term prospects were bleak. Cheap credit can be a powerful tool for economic growth. It allows businesses to invest, expand, and create jobs. However, like any powerful tool, it can be misused. When credit is too cheap for too long, it can lead to the creation of zombie companies. These companies become addicted to low interest rates. They are unable to survive without constantly refinancing their debts. This makes them highly vulnerable to any increase in interest rates. When rates eventually rise, as they inevitably will, these companies are likely to collapse. The problem is that these companies are not just hurting themselves. They are also harming the overall economy. They create unfair competition for healthy businesses. They tie up valuable resources that could be used more productively elsewhere. They also pose a systemic risk to the financial system. If a large number of zombie companies were to fail simultaneously, it could trigger another financial crisis. The retail industry is a prime example of how zombie companies can thrive. The rise of e-commerce has put immense pressure on traditional brick-and-mortar retailers. Many have struggled to adapt to the changing landscape. However, instead of going out of business, some of these struggling retailers have been kept alive by cheap credit. They have been able to refinance their debts and keep their doors open, even though they are losing money. This has created a situation where there is an oversupply of retail space. This drives down rents and makes it difficult for profitable retailers to expand. It also leads to job losses, as zombie companies eventually lay off workers in a desperate attempt to cut costs. Section 5. Tech Zombies. Innovation loses its spark. The tech industry is often seen as the epitome of innovation and dynamism. However, even this sector is not immune to the zombie phenomenon. In recent years, there has been a surge in venture capital funding, particularly for startups. While this influx of capital has led to the creation of many successful companies, it has also created a bubble in some areas. Some startups have been able to raise vast sums of money despite having unproven business models. This has led to the creation of tech zombies, companies that are kept afloat by investor funding rather than customer revenue. These tech zombies distort the market by driving up valuations and making it difficult for profitable startups to compete for talent and resources. They also create a false sense of innovation, as investors pour money into companies that are unlikely to succeed in the long run. Section 6. Starving the healthy economy. The existence of zombie companies creates an uneven playing field for healthy businesses. These struggling firms can offer goods and services at artificially low prices, as they are not focused on making a profit. This underpricing can drive healthy competitors out of business. Imagine a small independent bookstore competing with a large chain that's a zombie company. The chain can afford to sell books at a loss, subsidized by cheap credit. The independent bookstore, however, cannot sustain such losses and is forced to close its doors. This unfair competition stifles innovation and productivity. Healthy businesses are less likely to invest and expand if they know they cannot compete with zombie companies. This leads to a less dynamic and less prosperous economy overall. Zombie companies are like a drag on the economy, slowing down growth and innovation. Their presence discourages healthy businesses from taking risks and investing in new ideas. Why would a company invest in research and development when a zombie competitor can undercut them with artificially low prices? This lack of investment leads to lower productivity. Productivity is the key to long-term economic growth. When productivity stagnates, so do wages and living standards. Zombie companies contribute to this stagnation by creating a climate of uncertainty and fear. Furthermore, the resources consumed by zombie companies could be put to better use elsewhere. The capital, labor, and resources tied up in these failing businesses could be used to create new businesses and jobs in more promising sectors. This misallocation of resources hinders economic growth and prevents the creation of a more dynamic and resilient economy. While the rise of zombie companies is a global phenomenon, its effects are felt locally. In many countries, certain regions and industries are particularly vulnerable to the negative consequences of these struggling businesses. For example, in areas heavily reliant on manufacturing, the closure of a large factory that was kept afloat as a zombie company can devastate the local economy. Thousands of jobs can be lost, leading to a ripple effect throughout the community. This can lead to social unrest and political instability, as people become frustrated with the lack of economic opportunities. The presence of zombie companies can exacerbate regional disparities and contribute to a widening gap between the haves and have-nots. Addressing the problem of zombie companies is a complex challenge. There's no easy solution. Governments and central banks are reluctant to raise interest rates too quickly, fearing that it could trigger a wave of bankruptcies and potentially another recession. However, keeping interest rates artificially low for too long only delays the inevitable. It allows zombie companies to linger on, further distorting the market and delaying the necessary restructuring of the economy. Some economists argue for a more proactive approach, such as targeted government support for healthy businesses and stricter bankruptcy laws. Others believe that the market should be allowed to correct itself, even if it means a period of economic pain. Finding the right balance between intervention and letting the market work is crucial. The rise of zombie companies is a wake-up call for the global economy. It highlights the dangers of excessive debt, easy money, and the misallocation of resources. Addressing this issue will require a combination of prudent monetary policy, structural reforms, and a willingness to accept short-term pain for long-term gain. The future outlook for zombie companies remains uncertain. As interest rates eventually rise, many of these struggling businesses will likely collapse. This could lead to a period of economic turbulence. However, it could also pave the way for a healthier and more sustainable economy in the long run. The key is to learn from the mistakes of the past and to avoid repeating them in the future. This means promoting responsible lending practices, encouraging innovation and productivity, and creating a level playing field for all businesses. Only then can we hope to create an economy that is truly healthy and resilient.